We all know that capital markets are very dynamic, right? However, if you look at these two different strategies side by side, you'll see that one, that passive strategy is actually fairly static, right? It's all formula driven, mathematically based, right? So it's a bit of a disconnect to me, particularly at this point in time where we see capital markets potentially becoming more volatile. You've got global economies that are now disconnected. They're all on dissimilar paths. You've got central banks acting differently, fiscal authorities acting differently. So there's going to be nothing other than the opportunity to take advantage of this dynamic framework that is developing. And the only way you can really do that is through active management. You take another step back and think about it sort of in the similar light, and you say, well, with a passive manager, every dollar that you're giving to that manager is being allocated to, say, 500 different stocks. And some of those are going to be very deserving. There's going to be a tremendous amount of investment merit there. But regardless of that, your capital is being allocated towards a whole bunch of investments that have zero or even potentially negative investment merit. Whereas as an active manager, from our perspective, we're trying to use a very thoughtful, process-driven approach to identify the best opportunities from a risk-reward standpoint, build a portfolio one stock at a time, and constantly manage that in a dynamic framework that allows us to extract the best available opportunity set within the market. Very different approach. The final thing I'd say is sort of the linchpin of some of this maybe is that don't ever lose sight of the fact that the financial services industry is masterful at making money. They can figure out more ways to translate intellectual capital into financial capital for themselves than any other industry I've ever seen. And so if there is any sort of perceived need for any sort of product, they'll come up with it, and it's very inexpensive to create. You think about what Chris said, right? It takes some computing horsepower and a couple of smart math guys to manage billions of dollars of inflows and outflows. The extra cost, the incremental cost of doing that is very, very low. That's why you can charge 4 or 5 basis points for a fund. And I look at it and sort of say, a lot of cases, you're probably getting what you pay for. Whereas what we do, we've incorporated a very different process into what we do, and we're all thankful that Oak Harvest was willing to spend the firm's capital to put in place an infrastructure that allows us to serve a much larger client base and do it in a very thoughtful and institutionalized way that can deliver more value to the client.
Yeah, and I want to note something kind of forecast-wise. You've been rewarded since the great financial crisis of buying the S&P 500 and just literally staying put, right? Because every time something bad happened, COVID, the Christmas night, 2018, anytime the stock market looked like it was going lower, or anytime it was down, 15 to 20%, the Federal Reserve rushed in, right? And we've been doing that now since 2008. Mm-hmm. So it's been almost 15 years. If you look forward, given the state of the economy, all the changes that are going on overseas, given the balance sheet of the United States, and the mindset of people running it, I would not expect that to continue, right? So, people hate to hear it, but there was a lost decade, between 2000, essentially 2013, where stocks went nowhere. If you were in the S&P 500, if you were an active manager, you at least had the possibility of being allocated in the right groups, in the right stocks, to take advantage of the wide swings that transpired between 2000 through 2013. Same thing in the 70s. People want to, hey Chris, why isn't this the 70s? We have rampant inflation. Well, it's not as high as the 70s. I mean, my dad's 90 and I still remember him lamenting, he couldn't get a 15% CD anymore. So we're not there. But the 70s were very similar. There was a lost decade, right? But the market kept going up and down because the Fed kept changing its mind and there were some other things going on. So the stock market did nothing for almost a decade. So an active manager has a chance of profiting from that and helping you. A passive manager, it can't, right? He's just going to, more than likely be selling when the market's down, buying when the market's up, and going contra to what things are. Looking forward, we're in a very similar setup to where we were going into the internet bubble peak. I don't think we're there yet, but it could be a very difficult overall stock market for a number of years ahead because interest rates are higher. We have short-term interest rates now at 5%. A lot of people like that, right? 5% can get through some people through a couple of years, in retirement without volatility. There's no growth there. We're looking to be active managers, to find unit growth, to find pricing power, to help offset some of that inflation that's going on, and going forward, probably be making more decisions rather than less in the portfolios, just because you'll be rewarded for making more decisions more frequently as opposed to fewer decisions and staying put.